Wall Street welcoming a deceleration in producer prices. 30 minutes until the start of trading. I'm David Gura.
And I'm Vonnie. Quinn, Matt Miller and Andy Berger are off. Bloomberg Open Interest starts right now.
Coming up, Anthropic eyeing Decart at $6 billion. That would be the company's biggest deal yet as it gets closer to its highly anticipated IPO.
SpaceX passed its first lockup expiry test, but bigger swings may be ahead.
As I mentioned at the top, we got another sign of decelerating inflation after Wednesday's CPI data. Producer prices come in softer than expected.
All right, David, stocks that we were watching today, obviously earnings season has been slam dunk, but there are a few that are suffering. Cerebras, one of them, it reported a disappointing outlook for the year, despite its cloud business really quadrupling and core revenue more than doubling from a year ago. Investors, though, they want that growth to translate into profits faster as the company spends heavily on the data center infrastructure build-out.
The AI trade inescapable. Looking at Cisco as well, that company saying AI sales will make up about 10% of revenue in the coming year. The pressure now on that company to prove it can turn the global data center build-out into sustained global growth without sacrificing margins. Of course, this is a company that's been in networking for a very long time, trying to reinvent itself in recent quarters here as a company that compete in the AI space, Vonnie.
Yeah, investors seeming to want it to participate more in AI. Meanwhile, Bloomberg has learned that Anthropic is in talks to buy startup Decart AI for about $6 billion. The deal will be Anthropic's largest known acquisition. Let's get more from Bloomberg Tech's Ed Ludlow. What is Decart and why is it worth $6 billion to Anthropic, Ed?
Well, Decart has two parts to it. It does world models, AI models that understand how the world works, tries to simulate and anticipate what would happen next in the real world, grounded in real world physics. But probably the more important part of what Decart offers is software that optimizes chips for running those models. They basically make chips more efficient, which, given that Anthropic's biggest constraint is compute, both in terms of volumetric supply and the ability to operate with better economics, that would be a logical step for Anthropic to take. And part of the clue here in what we're reporting, citing sources, is that Decart would be integrated into Anthropic's inference team, which kind of suggests how they'll make use of that. But big picture, this is the biggest acquisition that Anthropic has made to date, and it's right before an anticipated IPO. So it's an interesting piece of M&A.
I want to bring up Cisco here. I mentioned it just a moment ago.
Sure.
This is a company that's kind of in the middle of this reinvention. We've heard from Chuck Robbins many times about the efforts it's going through to get to a position where it can compete with its rivals. What did you take away from those earnings yesterday? I guess there's a conservative estimate here for the future that didn't rub well with investors. Yeah,
there seems to be a disconnect between what they're saying in actual revenues and what the backlog relating to AI is. Cisco wants to participate in the great AI build-out. So in full year 26, Cisco had about $9.3 billion of orders, but then in the fiscal year 26 only recognized $4 billion in AI revenue. And you're completely right that the outlook here for AI revenue specifically, the first time they've given this kind of metric for fiscal year 27 is $7.5 billion. But that's only 10% of what Cisco anticipates to sell overall. So that's what the market's been trying to work out. Like, why are they not capturing that faster? Why is it not a greater proportion? Is it conservative, basically? And, Chuck Robbins on the call said that it was a prudent forecast and a prudent set of numbers to give.
And we should point out that it has been trading at or near records too, right, Ed? So, it's not that the market is completely punishing it. That said, you would think that it would be exactly what this market wants. So it's participating in the AI build-out, but it's also maybe a hedge against the AI build-out because it's not fully dependent on AI for its revenue.
Well, the market's interpreting that second part differently, Vonnie, just that it's still very dependent on its other businesses, core legacy businesses that don't have much to do with software. One thing that the CFO said is that, clearly AI as having a role in cybersecurity has been in the news cycle for some weeks now, and that they recognize both, within their own organization, but within customers, that is actual work that's being done now, AI in the cybersecurity context. And so from a software perspective, Cisco tried to sort of talk about that services opportunity and software opportunity as well.
To Cerebras now, and I keep wanting to say Cerebras. Sorry about that. Cerebras going forward here, Ed. This is a company that has not been public for very long. I think this is only the second quarter that it's been a public company and reporting earnings. And it has kind of a novel approach to chip manufacturing and design. Maybe you could talk a bit about that, sort of how it's trying to differentiate itself and sort of what its efforts in that regard say about how hard it is to compete with, of course, the mammoth in this field, that being Nvidia.
Yeah, so Cerebras doesn't sell chips. It doesn't have a sort of single GPU that it sells. It sells a server design where they basically have one massive giant chip on a single silicon wafer, completely different design, but their business is split in two. So there's that business of saying, here's the hardware. Ours is really good, it works well, buy that. In developing and testing out the technology, they built quite large cloud computing capacity to prove that the underlying technology works. They have this second business that is basically renting out that capacity. And what was interesting in the quarter gone is that kind of shifted where the cloud computing business was a greater proportion of revenue. It outpaced the sale of hardware. Again, this isn't expectations against reality story. You know, with everything that's happening in the AI build out, they came in above estimates in the quarter gone. Their full year fiscal guidance came in above street estimates. The market just thinks Cerebras should be capturing more because if their system is so good and it is a genuine competitor to Nvidia architecture or Nvidia systems, those numbers should be bigger.
Is it a question of timing, Ed? So in the sense that the market just isn't ready for this yet, or servers that are being used in current data centers that are already built, are, you know, those data centers can't accommodate these Cerebras the servers?
You know, this is also like highly analogous with Cisco. I mean, the way that Cerebras CEO Andrew Feldman described it to Bloomberg is that hardware orders are lumpy. You know, you guys have been covering earnings and financial markets enough to have heard the term lumpy. But I think you are right. It's a question of when an order gets placed and when that gets translated into revenue. These are very large-scale projects that are complicated. You know, Cerebras has a $10 billion agreement with OpenAI, which is a very nice big round number, but it's obviously split up over time and incumbent on Cerebras to deliver that. And Cisco said the same thing in trying to explain the difference between the backlog and actual realized revenues, that these are orders that get placed very far in advance and it takes time to implement them in the real world.
On that expectations versus reality story, Bloomberg's Tech's Ed Ludlow. Ed, thank you very much, and don't miss his conversation with the CEO of Cerebras. That's Andrew Feldman at 11 o'clock New York time on Bloomberg Tech. We got more evidence inflation isn't broadly accelerating. This morning's PPI data. I want to break it down with Michael McKee, Bloomberg's international economics and policy correspondent. Mike, great to have you with us, and let's put these data in complement with what we got yesterday. There was great relief, I think, in the market yesterday when we saw that softer than expected, or in line with expectations, CPI data. What can we take away from these numbers today on producer prices?
I would challenge one thing that you said.
All right.
Change the tense of the verb in your first sentence, and it's to say price pressures weren't.
Yes, it's backward looking, and we should note
July,
that. Yes.
Because some of this is going to reverse here. PPI headline comes in flat. That was the good news, but you know what happened? 3.1% decline in energy and 35% decline in fresh fruits and vegetables. Let us guess what that is.
Exception, yeah, sorry.
Yeah, so a bad pun. So there's two things that are going to rebound in August, at least the way things are going right now. But it did push the headline down to 4.7% from 5.5%, which is a significant drop. Same thing happened with core. And so we're going to have to look and see in August whether this changes significantly. Also, now that we have CPI and PPI, the economists are busy crunching the numbers, and we'll get some numbers from them in a bit on what this means for PCE. But in a couple of the categories that feed into PCE, they sort of offset. Portfolio management, which is always a big one on Wall Street, trades a lot. Wall Street prices go up a little bit. Portfolio services were up 6.5%. That'll certainly add to the PCE. And airline passenger services tickets, they dropped because, of course, fuel prices dropped during July. So on those two scores, it's reasonably offset, and we'll see what the PCE looks like. But it does seem, guys, that we're maybe going to see it rise a little bit in comparison to what happened to PCE and PPI and CPI.
So if we get a little hotter PCE, but we know that many of the inputs into the economy are actually cooling a little bit, would that be enough to let the Fed sort of look past a hotter PCE?
It depends on the components and what their weight is, which sounds very economist wonky. But you look at what's happening in AI, and electronic equipment was up by 1.1%, significant there. And then power transformers were up 4.1%. So you see the AI effect coming through in this. So there are definitely areas that could prop us up. The good news today, though, is jobless claims are still very low. 209,000. If you look at them on a percentage of population basis, we're still very close to the all-time low. So
the labor market very definitely holding up.
You can still get a job selling. Well, if you can sell lettuce right now.
All right.
There's a skill.
There is a challenge. Bloomberg Michael McKee, thank you so much. Let's get a check on markets now after that data and, of course, those earnings. As you might imagine, the Nasdaq not doing as well as other futures, but we are still higher fractionally. The S&P also pointing to gains for futures there. We are down 4.5 basis points on the 10-year yield. Look at that. That's a relief trade, no doubt, after the PPI data. Although, as Michael said, the PCE could be coming in a little bit hotter. 464.67. That, of course, after yesterday's auction, which hit almost 468 on the yield that was asked. Brent crude down about 2.5% as well at 86.73. A little relief in the oil market too. Now let's get a look at some other movers on our radar with Bloomberg's Hema Parmer.
Thanks, Vonnie. 3 stories I'm following for you this morning. First up, let's talk luxuries. Some of pain over at parent company of Coach and Kate Spade. Shares of Tapestry are down 14% in pre-market after posting a disappointing forecast for 2027. But Coach, some silver lining. Coach is the crown jewel. It saw a 15% jump in sales last quarter. Let's pivot to the ticket game. StubHub is putting up a mixed scoreboard. The company posted record revenue this quarter after huge demand from the World Cup. But investors are throwing a red flag. Shares are tumbling in pre-market, down 21% so far, after higher costs ate into profits, leaving earnings per share at $0. Management, though, still optimistic. It's actually raised its full-year forecast. And finally, a historic tumble for the e-commerce giant JD.com. It posted its very first quarterly revenue decline since going public in 2014. That's because earnings were compared to last year when the Chinese government subsidized big-ticket purchases to jumpstart consumer spending. Those are your morning moves.
Emma, thank you very much. Appreciate it. And coming up here, SpaceX clears its first lockup expiry test. We have more on that next. This is Bloomberg Open Interest. Now to high interest to look at the stories making headlines around the world. Colombia's earthquake death toll has climbed to 265 with nearly 3,500 injured and 500 people still missing. The president moving to declare an economic emergency. That move would unlock tax and spending powers to fund reconstruction. International rescue teams and aid are arriving as authorities race to reach isolated communities in that country. Manhattan rents just hit another record. The median rent on new leases reached $5,000 last month. That is up 6.4% from last year, as available listings plunged 39%. Brooklyn also set a record at $4,500, with more apartments moving off public listing sites. Renters are facing bidding wars and fewer options. SpaceX cleared its first major post-IPO lockup test. The expiration released more than 900 million shares for potential sale, but feared insider selling failed to materialize. Attention now turns to another lockup expiration on August the 20th, with Elon Musk shares restricted until June of 2027, Vonnie.
Let's get more with Bloomberg Equities reporter Carmen Reinecke. So it's been pretty unbelievable, this tear that shares have been on since the lockup. Were investors waiting for that potential downside catalyst to be passed?
Yeah, so a week ago today, we were waiting with bated breath to see what SpaceX would do when the market opened. So we knew that the lockup had expired, that all of these shares were going to be available to trade on the market. And the question was, you know, earnings were just the night before. The stock was down in the post-market. The question was, will insiders sell now? Will this, fall off a cliff? And that's not what happened at all. It actually ended up putting a floor under shares. So that low, about $110 per share that it hit that Wednesday, ended up being the floor. The stock went up on Thursday, and it's really rallied since it went back over the $135 IPO price, and we're up, nearly 50% from that trough. So it's really significant. It was a pretty major test. There was a lot of fear going into the lockup, which added to some of that downside pressure for the stock. And now we're just looking ahead to the next one in another week.
Another week. This is a unique company, a unique conglomerate. The lockup process here is unique as well, I gather. So we're looking ahead to the one on August 20th. What happens after that? Explain sort of how this is kind of a different setup than most companies would have.
It is. So there are so many shares coming online or coming to the market here that instead of the traditional 180-day lockup, there's sort of a 9-part staggered lockup expiration here. So we are seeing some more frequent lockups expiring. This first one that we saw last week was the largest, more than 900 million shares. The next few will be more in the 300 million share, about 7% ballpark. But that's still a pretty significant amount of pressure that it could add. And this is going to continue for the next year until we see Elon Musk's shares unlock next year in June.
Do we know who's been doing the buying? Have there been index buying? Has there been ETF buying? Is it all retail investors?
Retail is so strong here. It is, Elon Musk has so many fans. It's a huge part of the retail space. But I mean, we're seeing buying across the board, right? I mean, it is included in the NASDAQ 100. So ETFs that are tracking that index, there has to be some buying there. And I mean, it's about a year away at the earliest, but people will still be looking ahead to S&P 500 inclusion potentially here.
It's several weeks now since the debut, and there has been, as you've noted, a lot of volatility here, and we can use any manner of metaphors, kind of Newtonian gravity bringing the stock price down low. It's shooting up once again here. What are investors saying just about what their expectations are for the stock going forward here post-IPO?
Volatility is really expected to continue. I think if you're a believer, if you're a bull here, you are just holding on. You're saying, we're not really looking at the valuation. We are all about the forward vision. We're buying into what Elon sees. If you're a bear, then there's a lot to sort of pick at here because the vision is so far out ahead in the future. But I think across the board, everyone really expects this volatility to continue.
Carmen, great to see you. Thank you once again. Carmen RaeAnn joining us here on set in New York. And coming up here, Threadneedle's Ann Berry is going to join us to talk about the rebound in AI sentiment and the stock she sees with the most upside in the coming quarters. That's coming up on Bloomberg Open Interest here on Bloomberg Television.
The AI trade is finding its footing again after a volatile stretch. The rebound comes alongside a blockbuster earnings season. So 61% of S&P 500 companies that have reported so far have beaten profit estimates. 76% of those are beating on revenue. Concerns over stretch valuations or circular financing seem to be on the back burner as investors look ahead to AI monetization. Let's discuss all this now with Threadneedle Ventures founder Ann Berry. And the market focuses on one narrative at a time, right? And it's been the AI narrative broadly, but on each earnings season, we've had a different part of the AI narrative. What do you think the market is focused on this earnings season?
I think they're taking a look at revenue backlog, and what's becoming very clear is the data center bottleneck that is really driving the reactions we're seeing, whether it's the sell-off we're seeing in the likes of Cerebras, or on the other hand, if it's the victory lap that the likes of Nvidia is likely to do. I think we're now really seeing very clearly when the execution is going into play to get these data centers built out, to get this infrastructure done. We're seeing where the pinch points are, and we're seeing who wins and loses, depending on where you are in that spot in the value chain.
I imagine competing with that is productivity, though, and signs that AI is actually leading to something tangible in these earnings. Do you see any evidence of that as we make our way through this earnings season and look at those company profiles?
Yeah, I think a lot of people are actually finally saying, and this is in the application of AI as opposed to in the infrastructure side, folks are saying in software we're getting higher productivity from our engineers. Folks are saying when it comes to logistics, we're seeing improved use of our assets as a result of deploying AI tools. So I do think we're seeing it. What we're still not seeing, though, is forward-looking return on investment. We're seeing the anecdotes sprout. We're seeing by quarter, folks saying, look, we're seeing the earnings uplift here, but they're not giving long-range returns on investment outlooks quite yet.
Why is it so hard to forecast? It seems like each quarter investors just don't believe the forecast, and then they come true, and investors maybe this quarter for the first time are actually starting to believe the forecasts. But surely it's something that we can quantify, no?
It's a really, really good question. And here's where I'm a bit perplexed. I think we should see better and more accurate forecasting when it comes to CapEx, Vonnie, because when you think about the scale of these CapEx budgets, there's absolutely no way that executive teams and their boards are having surprise discussions, right, and out comes a new announcement at the time of earnings. There's a much longer lead time for this. So I think it's about managing expectations, and I think we're seeing these big companies unclear how to anticipate what expectations are, to really read the sentiment and how to manage it appropriately. I do think that we're able to see a lot more accurate guidance again when it comes to the applications of AI on things like software and on things like consumer products that are using it along the supply chain or manufacturing, for example. Yeah.
Vonnie's saying there's an impulse here to focus on one narrative here. I suppose macro is the other one competing for that. And I'm curious how you're thinking of that in light of the earnings season we've seen thus far.
Yeah, and I said this to Vonnie last time I was on here. I'm utterly perplexed that the macro does not take more consideration when it comes to the consideration of these markets. They're so benign. News that would roil any other market almost gets a shrug and no reaction here. Two things I am looking at, though. The narrative around the deficit in the United States, I think, is going to get more attention as we go into the midterms. The narrative around global deficits, look what just happened with Japan, and the support for the Japanese yen is going to get more focus. And we just saw this Treasury auction this week, so I think that's going to get louder. But again, the markets will shrug things off for the moment.
I mean, the VIX is trading at a 14 handle, and the MOVE index, it's maybe not at its lowest in the last year, but it's pretty low.
Yeah, summer vibes. People are on summer vacation, including the traders.
That's definitely part of it.
Yeah, but there's not a lot of fear that's coming up at the moment, for sure.
We are seeing dispersion, though, so not so much this month, but year to date, we're something like 17.5% dispersion. So the rotation trade is a little bit alive. It's maybe not as healthy as it was earlier in the year, but there's still some rotation there.
There is a little bit of rotation. I think there's still a distinction between the small caps and the large caps. What we're really seeing, too, is we've seen the dispersion happening on a micro level within sectors a lot more closely now. If we look at the consumer earnings, for example, and we look into subsectors in consumer earnings, even something like the restaurant sector, right, we've got different earnings coming out, Wendy's going in one direction, Outback going in another direction. How consumer companies are playing the K-shaped economy or winning or losing there is an example of how we now need to dig deeper to try to understand dispersion in subsectors.
Don't go anywhere, Anne.
I'm sitting
have to help us make sense of this market once it opens in just a few minutes. Anne Berry is sticking with us through the open. Let's get a check on markets now ahead of the opening bell. You can see futures pointed higher once again after a nice up day yesterday. We have that 10-year yield back below 464 now, and oil dropping too.
We're moments away from the start of trading. Again, markets reacting to that producer price index data that came out this morning. Inflation decelerating. Let's take a look at where futures stand here as we make our way to the opening bell in just a matter of seconds here. We see the S&P, those futures up 0.3%. NASDAQ futures up 0.2%. Same here with Dow futures as well. And I look over here at what's happening at the New York Stock Exchange. The Robinhood Ventures Fund 2. This is a new closed-end fund being debuted on the New York Stock Exchange today. I believe kind of inspired by or focused on private companies that have been funded by Y Combinator, that Silicon Valley private company accelerator. We see them ringing the bell. Looking over the NASDAQ market site here, First Phosphate, battery company based in Quebec, focused on lithium batteries here. That company debuting just a couple of days ago, I believe. We have them ringing the bell at the NASDAQ market site. Vonnie.
Well, I'm looking at Cerebras because it is doing a little better than it was in the pre-market, but still getting absolutely slammed. It reported a disappointing to investors outlook for the year, despite its cloud business nearly quadrupling and core revenue more than doubling from a year ago. But it seems investors want that growth to translate into profits faster as the company spends heavily on the data center infrastructure build-out, David.
Yeah, the same can be said for Cisco, Vonnie, as well. It says AI sales will make up about 10% of revenue in the coming year. The pressure now on Cisco to prove it can turn the global data center build-out into sustained growth without sacrificing margins. I want to bring back in Threadneedle Ventures founder Anne Berry, and we're talking about Cisco, Cerebras, every day in this AI trade, another company kind of disputing the narrative or encouraging it. And I'm curious of what you take away from what we've been through here. Yes, we've had all the hyperscalers reporting. That was kind of mixed here. How do you see the AI trade at this point?
I think it's going to be continuing to be super volatile. Yeah. And here's the problem. So much growth has been priced in. Let's take Cerebras. That's trading on any given day between 50 and 100 times revenue. Margin compression across the board is a concern. Everyone's already overinvested in these names, right? Because we've all ridden the run up. I just find it personally very hard to add. I don't want to sell either, so I'm looking elsewhere. I'm looking a lot more at physical AI, which is the new name for what used to be called robotics.
Robots. I was going to
right?
sorry.
Which used to be called automation.
Yes.
Yeah.
Right? And so I've spent a lot of time, actually, I've been investing in that space for well over 15 years at that point, and I'm looking at those names. Again, they're expensive, but the way I think about it is, if the infrastructure build-out is going too far too quickly, if we see the prices that the hyperscalers can charge come down, the beneficiaries of that are those who are building off that infrastructure and what's being provided. So that's where I'm looking.
Are there some names we should take note of that might be going public at some point, Anne, that you want to share with us?
Well, going public. Well, I think there's a lot of names sort of elsewhere in the private space I do look at. They would benefit from it, but more on things like drones, which you and I have talked about before. But look, I'll tell you where there is one area of the private market that does have assets sitting in the space. Private equity, actually, if you roll back sort of 7 to 8 years, was going after the automation play. At the time, it was called the Internet of Things. Do you remember this?
Yes.
The IoT trade. And I remember running after these assets, Vonnie, and high teens multiples, EBITDA multiples were being paid for things making LiDAR elements and sensors and automation components. And at the time, I remember thinking, wow, I'm going to have to hold my nose if I want to pay these multiples. Those companies are due to come out as IPOs at some point. They haven't yet at scale. A lot of them are also being wooed by public companies, also trading at high multiples, but they can afford to pony up as strategics. That's where I think we're going to see deal activity continue.
Okay.
I stand over there in the corner. Sometimes the company ringing the bell is interesting. Sometimes it's less interesting. We have this closed-end fund debuting from Robinhood.
Yes.
We're focusing on the private markets,
Yeah.
and that does interest me. The kind of wider interest in getting into companies here at an early stage. You're in venture capital. What do you make of that kind of level of excitement that we're seeing kind of manifesting itself in these new funds that are being introduced on the New York Stock Exchange?
I regret to say I'm quite nervous about it all. And here's why. These companies are private and illiquid for a reason, right? They're private and illiquid because you don't have the transparency around the valuations. It's quite hard to get to fundamental value. Venture capital has risen as an asset class with a core skill of being able to look at businesses that often are visions and dreams and about backing the founder. Most people don't have that skill set, and it's not because people can't, it's because reps, pattern spotting, pattern recognition is so critical, and networks and insights. And it's very hard for most investors to have that if they're not doing this all day, every day professionally.
That's for sure.
I do worry. It is very tempting to hop into these sexy names, but if you buy the funds that are going public, how do you as the retail investor diligence the underlying companies that sit within that fund? The trust you need to have in that fund manager is very, very high. I just worry for this class, which is the publicly traded funds, they're not quite there yet.
Good warning there. And how much do you think about these yields for the companies that you have in your portfolios, and how much it's maybe a threat to them going forward?
Well, I think for tech, everyone is now breathing a sigh of relief because we're seeing this inflation data decelerate, which takes the pressure off perhaps the Fed taking a look at a rate hike for September. And I think the tech trade will continue to be very sensitive to it, Vonnie, including on the private side with, again, one exception. AI is continuing to get outsized interest. That being said, I am seeing the venture market, the growth stage market, be a bit more discerning now about which kinds of AI companies they are investing in. So I think, again, there'll continue to be interest rate sensitivity with the exception of where there's super high conviction around being able to ride the AI wave.
You brought up deficits a moment ago, and I got to go back there. I mean, this talking about sexy names. Deficit often not something that people want to talk about, but it does percolate up from time to time that there's concern about it, often when there's kind of a debate over government funding. You mentioned that auction yesterday. Are we approaching a moment when investors are going to take it more realistically? There's been kind of a blasé approach to the whole thing for many years now.
We just saw the July deficit data come out, which was the highest it's now been. This is the US fiscal deficit since March of 2021, right? Since, almost peak COVID stimulation spending. That I find very worrying. I do think the light will continue to shine on it. But again, the sentiment around what's going on elsewhere in the market, the earnings expansion is, I think, getting much more attention and buoying up the trade here. If other things start to crack, right, if oil jets back up again, if consumer weakness picks back up, wages are growing less quickly than profit growth. If we see, consumer spending slow down, consumer debt servicing start to struggle, then I think at the bottom of the list, people start looking at the deficit again. I find it very odd. I find it actually very nerve-wracking, but I think that's the order of operations for the market deciding how nervous to get.
Yeah, a few more imminent things to worry about, perhaps.
Yeah.
What are you hearing in terms of employment from your portfolio companies? Are they continuing to hire? Are they hiring freezes? Are they even laying off?
That's a great question, and the answer, Vonnie, is function by function. The review of headcount, and we're about to go into budget season. Companies now are going to, once you hit September, companies are doing their planning for 2027. So we're going to get a lot more visibility into that. The big question that's starting now is, what can we do to use AI to automate or get more productivity from our existing headcount? Let's start there. And then let's decide if we're going to hire on top of that, and let's going to decide if we're going to upskill is the other piece of this. So look, marketing functions. It's worrying. Lots is being automated. Finance functions, there's a lot more sophistication now there. Where it's growing, sales. Sales teams are growing across the board, including for AI companies and including for tech, because the people to explain how to drive adoption to potential clients, that skill set is hugely and wildly in demand.
All right, Threadneedle Ventures founder Ann Berry, thank you so much,
Ann.
as always, for joining us. Let's get a check on the stock market right now, and I can tell you already that we are in the green. Plenty of companies, in fact, the vast majority, 358 higher, 143 lower. So we're continuing yesterday's uptrend in spite of a few disappointments maybe in earnings overnight. So let's take a look at the ones that are doing so well. Well, Nvidia seems to always top the leaderboard here when it's higher, right? Because it has the heaviest weighting, obviously. But we're seeing Apple for the first day in several higher by 0.75%. Some of the software companies, some of the hyperscalers, a lot of the chip companies, and even Netflix is up 3.25% today. We even have some of the pharmaceuticals. So it seems to be a broad-based rally. Let's take a look at the downside. Well, as we know, Cisco Systems disappointed investors, though we should mention it has been trading at or near records. Coherent was the other one that jumped out. That was an optics play, and that also disappointed investors. We didn't think optics companies could do any wrong, but apparently they can. And then there are a few of the financials a little bit lower. Tapestry as well. This is another earnings downward spiral for this company, even though on many metrics it actually beat, and Coach did extraordinarily well. Kate Spade, even though it beat, was down. So a lot of variety in this market today. Let's take a look at the groups that are moving. As you can see, most of them are higher. Real estate tops the index today, and that's perhaps off the back of the more benign PPI data, so perhaps there's a little bit more room for the Fed to stay on hold. As you can see, the energy index is lower, with oil down about 2.5%. And we have consumer staples and infotech higher as well. David.
Vonnie, thank you very much. Coming up here, some AI stocks are taking a hit despite massive growth, raising their outlooks. Details next on Bloomberg Open Interest.
A check on markets now. We are approaching session highs with the Nasdaq up a nice 0.6%, and the S&P 500 up almost 0.5% after some gains yesterday too. As you can see, we are seeing oil down and yields down as well, as the two quite frequently go hand in hand. Brent crude actually at 87 and change now, and that 10-year yield, after getting off that auction yesterday, down to 463.88. The more benign PPI data apparently helping as well, down 5 basis points. That is quite the move. All right, let's get to some top calls now. Here's Bloomberg's Hema Parmer with some of the analyst action in focus this morning.
Thanks, Vonnie. Let's kick things off with a bullish call on the discount aisle. Jefferies is upgrading Five Below. The company says the discount retailer is becoming a more consistent growth story instead of relying so much on whatever products are trending. With the store performance ticking up and earnings growing faster and expansive plans on the table, analysts are more excited about this stock. It's up 1.2% so far. Let's move over to tech. JP Morgan is giving Akamai a boost. It upgraded the company, saying its cloud business is growing faster. That's giving the bank a lot more confidence in Akamai's outlook. JP Morgan still wants the company to make a bigger splash in the AI space, but says its solid business mix should keep cash flowing over the next few years. And staying on tech, let's dig into Cerebras. The chip maker projected slower growth than some investors anticipated, a sign that the company is still in the early stages of popularizing a novel chip design. Morgan Stanley calls the weakness a buying opportunity, pointing to upside in the hardware and cloud revenue. But Barclays notes that tomorrow's lockup and expiration may be weighing on sentiment. Those are your top calls. David?
Emma, thank you very much. I want to discuss Cerebras and more with Bloomberg tech reporter RaeAnn, who joins us now from Chicago. RaeAnn, great to have you with us here. And Ed Ludlow a few minutes ago talking about this binary between expectations and reality, and maybe in the context of this company, it really coming to the fore in what we learned yesterday. Your reaction to it, are you, as you look at sort of the backlog here, the promise of what it can do versus what it's been able to deliver, and any signs of worry for you?
I don't know if I would go so far as saying that there's a big worry out there, but a lot of these stocks have done very well this year, and a lot of expectations got really elevated. So if you look at companies like Cisco, like Cerebras, people were really expecting to see this AI tailwind come in an extremely pronounced way. And while these companies are talking about AI growth, and the growth remains pretty strong, and it looks to be at least fairly durable in the short term, I don't know that it was quite strong enough to justify how much these names have been moving up, how high valuations have gotten in some cases. You mentioned Coherent earlier. All of these optical stocks, some of them have more than doubled this year, more than tripled. And so there's a lot being baked in when you see moves like that, and even just beating and raising. In some cases, it's just not enough to keep extending the kinds of rallies that we've been seeing throughout this year.
Who does Cerebras cater to, RaeAnn, though, given the size of its chips?
Yeah, I mean, all these companies are really getting involved in the AI space, a lot of data center interest right now. Cerebras, it has chip design, it has chip making. It's a newer company out there, so it's not quite as established as some of the other stocks that we've been talking about when it comes to the AI trade, but certainly one that people are paying a lot of attention to. There was a lot of attention on the IPO.
I think of the constellation of chip companies we've talked about over the course of the week, so certainly Nvidia with that financing deal, Intel when it announced a deal of its own, and now this one. It does make me wonder about the prospects for competition against Nvidia, that it is just such a huge part of this market here. It seems incredibly difficult for others to compete. What do these results from this company tell us just about the challenges of doing so, finding a lane here in this chip, the AI chip world here, given Nvidia's prominent role?
Well, I would say even though Nvidia is very prominent, a lot of the things that I am told from investors is that the easiest path for Nvidia's market share is to go down, just because we are seeing so much competition in this space. You're also seeing it from some of Nvidia's biggest customers. You have Alphabet, most notably, but also Amazon and Microsoft. All these companies have their own internal chip design businesses, and they are trying to reduce their reliance on any single supplier. So I would say that for Nvidia, while they remain the absolute dominant player in the industry, there is a lot more people coming into this arena, probably going to be a lot more competition, including on pricing, chip design, and so forth like that. So I would say the bigger issue is probably on Nvidia's side. How much can they defend what right now is a pretty dominant market share?
If we move to Cisco, RaeAnn, is Cisco choosing to be a little bit reticent on the AI play, or has it just not been able to transfer its resources enough towards AI selling?
Well, a lot of analysts said that the outlook that Cisco gave was extremely conservative. And this is a company that it has seen a lot of demand for its networking equipment. It has its own optical products that have seen a lot of demand. This is another stock. I think it was up about 60%, like you said before, trading around all-time highs. So this is a company that certainly has its irons in a lot of different fires when it comes to AI. It seems like there is a lot of optimism about its ability to participate in the AI infrastructure build-out, but the forecast was pretty conservative, and it was kind of underwhelming, especially in the wake, like I said, of these elevated expectations and a stock move that has been pretty dramatic to the upside this year.
There are new companies in this space. There are companies like Nvidia who've been kind of in the chip space, but have kind of pivoted to focus more on AI quite successfully. I think of Intel's reinvention too. When it comes to Cisco, how is that reinvention going? We think of this kind of as a legacy networking gear company. How hard is this pivot going to be for it going forward?
Yeah, it's interesting because Cisco was really the main name of the .com era. It actually only recently took out its .com era peak, and that is really because of the growth it is seeing because of AI. People are building out their networks. People are building out the infrastructure. It's like I said, Cisco's optical products are seeing a lot of demand in this kind of backdrop. I do think it is doing a pretty good job of pivoting to focus on AI, but like you said, just not quite enough, at least in the short term, to help justify a stock that's done pretty well this year.
All right, RaeAnn, thank you so much. That is Bloomberg's RaeAnn Blastelica for us. Coming up, shares of the parent of Coach and Kate Spade, Tapestry, falling on a disappointing outlook. That's next. This is Bloomberg Open Interest.
Bloomberg Open Interest. I'm David Gura. Let's take a quick check of stocks here. A few minutes into the trading day, we look at the S&P 500 up about 0.5%. The Nasdaq up a full percent. Russell 2000 looking at those small caps up 0.4%. A lot of enthusiasm here in the market for what was a relatively benign producer price index reading this morning on the heels of the CPI read that we got yesterday. Looking at the macro in more detail here, still following the story out of the Middle East. The prospect potentially of a deal when it comes to the Strait of Hormuz. Seems like we haven't made a whole lot of progress over the course of this week, a lot of back and forth. We see oil giving away some of the gains that we've seen since Monday of this week. Want to look at a few companies here in particular. StubHub down 11% this morning thus far. Disappointing earnings report from that company. Dell Technologies up 2.7%. This is on strong results from Lenovo. We're seeing kind of ripple through the sector. I live in Brooklyn. I got to cite Birkenstock. It's doing incredibly well after boosting its forecast. We see it up 17%. Tapestry down 14.5%. This is, of course, the parent company of Coach and Kate Spade. One of those properties doing well, one of them not doing well. Shares sliding on a disappointing forecast here for 2027, Vonnie.
Wow, side by side, that's some picture of the consumer. Well, I live in Manhattan, so for more on Tapestry's earnings, let's bring in Bloomberg The Close co-anchor RaeAnn Bostic. What a punishment for Tapestry, and it beat on many metrics, RaeAnn.
Yeah, this is kind of like the curse of high expectations. I mean, this is a company that should be running on all cylinders. And when I say company, I'm going to put a big asterisk there because this is basically Coach and Kate Spade. But when you look at the revenue and you look at where the growth is coming, they might as well change the name of this company to Coach. They basically had $1.9 billion in net sales in the most recent quarter. 1.6 billion of that came from Coach alone. That is the growth story, and it has been the growth story for a while. It's running in the double digits. It continues to run into the double digits, but there's this concern that that's going to start to normalize. They gave a revenue forecast for the full fiscal year, the fiscal year that just started in July. It was basically in line with estimates. And we know in this environment right now, in line is not enough for most investors, particularly for a stock that, let's not forget, had run up about 20% heading into this print.
Exactly.
Stuart Weitzman used to be under the aegis of this company.
Yeah,
it is no longer now. You look at Kate Spade, new creative director in place. What does this company say about the prospects of turning around that other side of this business?
Well, I've interviewed the CEO in the past quarters about this, and they've talked a lot about how the reinvigoration of Coach, because remember, Coach had kind of lost its mojo for a while, and it's back in a big way, and it was very deliberate. They really focus on Gen Z. They really focus on affordable luxury, finding that kind of that point kind of just below kind of the LVMH type brands, but above kind of those mid-level ones that you see everywhere. They got rid of, they improved their inventory situation, and Coach took off. So my question was always, can you apply that playbook to Kate Spade? And they were pretty confident they could. I think I asked that question probably, maybe 6-9 months ago. There's still a lot of questions as to when we actually start to see that playbook roll out and actually start to take effect.
I remember that interview, and I remember how optimistic it was. It was no, but I do, and it was a very optimistic interview. That said, what is the consumer that they're targeting here? I like to think of it as maybe the consumer in the crook of the K, right? Because it's not the consumer that's at the high end of
that's probably a good way to define it. I mean, they'll tell you, look, they want a kind of higher-end Gen Z type of consumer. That's what they're going for. And when you look at the price point, and they've been very clear about holding the price point. I mean, their bags kind of top out around $1,000, but there are several you can kind of get in that mid-$500 range. And they've been very clear that they want to kind of stay in that kind of price point, meaning not go too far above it and sort of press their luck, because they feel like this is kind of the sweet spot where you can get sort of younger people who maybe don't have a lot of disposable income but are willing to splurge, and then as those younger people age and their income levels go up, they'll still be loyal to the Coach brand.
And noting how far it's fallen here over the course of the trading day, down 15%. Look, the company expecting to buy back $1.35 billion in stock, approving a 16% increase to the dividend. What does that tell you just about the stock directionally?
Well, I mean, we should point out, I mean, their EPS is good, but a lot of the EPS, particularly with their EPS forecast, is kind of that buyback. I mean, you strip out that buyback and the EPS growth looks a lot worse. And that's a big part of the concern as well. They've done a good job in holding margins. And Joanne Kurvasa, the CEO, she's talked a lot about cost discipline. It's something they're very clear about doing. And investors have rewarded them for that. And again, when you look at them stacked up against other publicly traded retail fashion companies, they're still doing well. But you see the reaction there in the shares today. I mean, this is setting up to probably be the worst day that they've had, at least going back to actually about a year ago when they reported earnings, and their earnings got got hit because of Trump tariffs.
Well, as we say, they have had a good run up.
There you go. RaeAnn, thank you very much.
Are you a Stuart Weitzman guy?
I'm not.
Oh.
I could be,
Not
though.
anymore,
Maybe.
anyway.
RaeAnn Bostic, thank you very much. Of course, the anchor of the close. Coming up in the next hour here, Callan Family Offices, RaeAnn Mitrione joins us. Just going to see where she sees value in the market today. That's coming up. We're 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm David Gura.
And I'm Vonnie, Quinn. Matt Miller and Danny Berger are off. This is Bloomberg Open Interest.
Yes, coming up here, stocks closing in on fresh records after another encouraging inflation read.
Meanwhile, the oil rally stalls as a deal to end the Iran war remains elusive.
And global trade keeps humming, shrugging off extreme weather, wars, and tariffs. We begin with producer price pressures easing in July. Michael McKee, Bloomberg's international economics and policy correspondent, joins us at the desk. Let me pull an audible. We'll get there. We're going to get to those numbers in a sec. But Beth Hammack, the Cleveland Fed, speaking just moments ago. Anything new from her commentary, kind of shaping our perspective or sense of what these policymakers are thinking as we look ahead to Jackson Hole in the September meeting?
The only thing you could say is she's one of the hawks and dissented at the last meeting, and the inflation numbers we've got in the last couple of days have not changed her mind. Here's what she said. I love to see that those numbers are coming in lower. That's a good thing, but I don't have confidence we're going to continue to see that. I think we need to act now. So Beth Hammack is still voting.
The cries of the hawks getting louder, I think, yes.
So we heard from Beth Hammack and Tom Barkin. That seems to be pretty much it this week. Is there anything that we should read into the fact that we've already heard from those two and that nobody else is really speaking?
It's hard to tell. It may be because people decide to take some time off because Kevin Warsh wants them to, or it may be just because it's August and you guys are sitting here because Danny and Matt are not here. You know, everybody's gone for the month. So we'll have to wait and see how it plays out the rest of the month. The focus is obviously going to be on Kevin Warsh when he gets to Jackson Hole and whether he wants to add to this discussion. He could argue that maybe we're looking at a hold as of today, given the numbers we got. You saw the PPI numbers. The PPI headline was flat during the month. However, that was pushed down by energy prices and fresh vegetable prices, the lettuce boycott that's going on around the country. That's not going to be repeated. And so the numbers are probably going to go up when we get the August numbers in September. And the PCE, which comes out at the end of the month, and that's the Fed's target number, does look like it'll be up a little bit. Portfolio services were up a big 6.5%, offset some by airline passenger services and healthcare services, which also goes into the PCE. Most of those categories were flat, but we're still, according to the economists who've crunched the numbers so far, looking at a small increase in PCE, and it's going to come down to the 3 digits. And if they round up to around 3%, you got people like Steve Stanley saying Beth Hammack is right. They're going to want to move.
For the record, thrilled to be here on this August morning. Just want to say that. Mike McKee, early on in this conflict, early on in this war, we heard from policymakers that they have a tendency to want to see through a conflict like this one. As we reach the 6-month mark here, how difficult does that become for policymakers to do?
Well, it's very difficult because it's been a series of supply shocks. We've had the Russia supply shock from the war with Ukraine, and now we've got the supply shock from what's going on in the Middle East. And so it's hard to know what's going to happen going forward in either of those theaters. So it's hard to know what will happen to energy prices. But we saw energy prices decline big in July, and now they're going back up again. So it's hard to look through it, but the other issue is that the hawks on the committee are looking back pre-war, pre-Middle East war, and saying, well, that's where we are right now. The same level of inflation we're back to, but we didn't like that level of inflation at that point. So you can look through the energy numbers and you can still have people unhappy about where inflation is and wanting to raise rates.
Well, we saw the Treasury curve come down 4 to 5 basis points in the last couple of hours. We'll see what happens at 1 o'clock with that 30-year auction. Michael McKee, thank you so much. Turning back to equity markets now, RaeAnn Mitrione, Callan Family Office market strategist and founding partner, is bullish stocks, writing, quote, "This broadening of participation is a healthy development and creates a more resilient foundation for equity markets." RaeAnn joins us now. It feels like the broadening took a little bit of a pause this month, RaeAnn, with everybody back on the AI narrative. But year to date, there has been significant broadening. At what point do we see that really take off again?
Good morning. It's been a great year to see some of that happening, where we're not in a market anymore that's just led by a few mega cap tech stocks. So we've seen, small cap doing well. We've seen international stocks on the developed and emerging side doing well, and value doing well, really across the market cap spectrum. And some of that has shifted more recently, especially with a lot of the strong earnings we've seen in the tech names and reinforcement of the demand for, all things AI related. So, but all of that is just a full reinforcement because we've seen broadening in earnings as well. And as long as the strength in earnings continues to be really broad-based, we think there's support for the broadening out in the market to continue.
10 of the 11 of those sectors experiencing year-over-year earnings growth. And I wonder if you're optimistic that that can continue here. And again, we've been talking so much over the course of the last week about the AI trade. It still is something that seems unavoidable for investors.
It is. And we do think that the demand is there, and there's still a lot of work to be done in the AI build out. So we think there's opportunity that remains within tech. But really, we haven't even barely started to see the productivity gains across other sectors when you look towards adoption. We're still really in pretty early stages from that perspective. And so we think we have more room for productivity and corporate profit margins to continue to improve really across the board outside of just what we've seen so far within tech.
So RaeAnn, what are you counseling the families in your office to do, particularly about the AI trade? How many times have we thought we were cresting or we were at peak and still we see higher highs?
There's been rotations, right? We've seen a lot of changes this year, whether within the technology sector, whether it's related to the mega caps, whether it's the software or the chip names. There's been a lot of volatility within there, but there is still opportunity. Now, we've seen so much of a run up and profits in that area that we are looking to take some of that risk off the table and have been rebalancing into other areas. And we think, there's an opportunity in value, in small cap, in, other parts, even within the AI trade, where you see with all the data center build outs, what we need with power generation and electrical equipment and the industrials that are going into all those build outs. So there are a lot of parts of the market outside of just looking at the true AI related stocks that have been benefiting, and we think will continue to benefit for some time.
What's worrying your clients, if anything? Are they the kind of macroeconomic issues? Are they having to do with politics and policy? We were talking about the deficit just a few minutes ago. So what's front of mind for them, and sort of how do you assuage the concerns that they have just about the health of the economy and how that's impacting the market going forward?
Yeah, I think investors overall, our clients feel pretty good. Obviously, markets have been good. It doesn't feel like an overly exuberant market. But just looking at how much more can this run, how exposed am I? Do I have exposure to all the areas of opportunity with what we're seeing going forward? So we're looking at, we have pretty diversified portfolios. So we're making sure that we have, equity portfolios on the public side that have U.S. and international exposure, that we have exposure to tech and AI, but also the other diversifying areas in the market, as well as exposures in the private markets and to fixed income where it makes sense to provide some more stability, when we see some more of this market volatility. But just that we've really rounded out the diversified picture that can hold up given any market environment that we see. And a lot of our clients really have multi-generational time horizons, given the ultra high net worth profiles that we typically work with. So they're less concerned with the day-to-day volatility and more looking forward to how should I be positioned for the real long term.
RaeAnn, you say you have increasing exposure to small caps. How concerned are you for rising interest rates for small caps?
I will say that the shift in the narrative around interest rates this year makes us a little less bullish than we might have been coming into this year. But we still see a lot of opportunity within smaller companies, and also for the potential for AI adoption to have more of an outsized impact in smaller companies that have the ability to be more nimble and flexible than larger companies in adopting new technologies, redesigning their workflows, and pivoting in ways that they could see more of a benefit to their profit margins and productivity that previously would have required a much larger investment. So we do think that there's opportunity in smaller companies, especially as the economy is continuing to remain strong for us going forward.
Just wrapping up here, let me marry kind of your outlook on the markets with the data that we've gotten over the course of this week. And so, yes, new inflation data, which seems to have bought the Fed a little bit more time here. So how do you think about that from a markets perspective?
We think that's helpful. Of course, the markets prefer for interest rates to stay lower, and we've seen that reaction. And with this tamer data that we've gotten over the last couple of days following the softer labor market report on Friday, all of that has led to maybe giving the Fed a little bit more flexibility to wait. And we've seen the shift there in the market, expecting probably that we may not see a rate hike in September. So if we have a rate hike or two over the next year, we don't think that would have too much of a negative impact on the markets. But anything more than that, we might have a little more of a concern.
All right. Thank you for joining us today. That is RaeAnn Mitrione of Callan Family Office. Thank you. Let's get a check on these markets now. With the Nasdaq 100 up 1.1%. I can tell you the best performer in there is ARM Holding. It is up more than 5%, but you also have some of the memory names like Western Digital doing well. The NeoClouds, CoreWeave up more than 4%. Nebius joining it. And AppLovin up 3.5%. We're going to be speaking with a competitor to AppLovin a little later on. The S&P 500 up just a little less than that, 0.75%, but broadly risk on, and you can see that in the Treasury trade as well. That 10-year is just absolutely plummeting. The yield now at 4.6171, down 7.5 basis points, and I can tell you that's the story across the curve as well after the PPI data came in pretty benign. And also, as you see oil continue to drop like a stone, down 3.5% on the front month futures now at 85.91. Let's get a look at some other movers on our radar now with Bloomberg's Emma Palmer.
Thanks, Vonnie. Yeah, risk on market, but we are seeing some pain here in the tech stocks. We're watching three this morning for you. Let's start with Cisco. The stock down significantly after it projected sales that disappointed investors, even though it sees $7.5 billion in sales this year tied to the AI data center boom. Investors were expecting billions more given the size of its order book. Meanwhile, Cerebras also getting punished this morning despite raising its annual sales outlook. Traders are questioning how quickly the AI infrastructure frenzy will translate into revenue. And don't miss our interview with Cerebras CEO Andrew Feldman on Bloomberg Tech at 11:30 New York time. And finally, a historic tumble for e-commerce giant JD.com. It posted its very first quarter of revenue decline since 2014. The CEO warning of near-term revenue headwinds as consumer sentiment in China has weakened, down nearly 7% this morning. David, it's a painful morning for some of these giant companies.
Brutal morning in stark relief in that red text. Thank you very much, Emma. Really appreciate that. Coming up here, Maersk raising its full-year outlook for the second time in 7 weeks. We're going to discuss the freight industry next. This is Bloomberg Open Interest. Now to high interest to look at what stories are making headlines around the world. Hedge fund billionaire Bill Ackman taking aim at the private markets. Pershing Square planning a new evergreen venture fund designed to give everyday investors access to pre-IPO companies. It'll launch with private investments from Pershing and Ackman's family office with a potential debut later this year. DeepSeek raising prices more than fourfold for its flagship AI models starting next week. The move matters because DeepSeek helped to drive the industry's race toward ultra-cheap AI. Now, higher prices suggest even low-cost leaders are feeling the strain of expensive computing and rising demand. Even with the hikes, DeepSeek remains less expensive than several major rivals. Bloomberg has learned that Anthropic is in talks to buy the AI startup Decart for about $6 billion. That company develops world models and technology designed to make AI computing more efficient. If the deal is completed, it would be Anthropic's largest known acquisition as the company ramps up its infrastructure ahead of a potential IPO. Vonnie.
Well, David, Maersk raising its full-year outlook for the second time in 7 weeks as the container shipping giant benefits from higher freight rates. I spoke with FreightWaves CEO Craig Fuller about the current state of the industry.
Freight recession's been over since November, and everybody's celebrating because it's been a miserable existence. Ocean container lines, they were out of a recession pretty quickly. They had about 8-month recession, but trucking has been was in a recession really since 2022, and it ended in November of this past year of 25, and so everyone feels relief.
Joining us now is Lee Klasko, Senior Logistics Analyst for Bloomberg Intelligence. How are these container shipping companies doing it, Lee? Having to deal with new routes, traditional routes being off limits and so on?
Yeah, surprisingly, Maersk's management noted that about a third of their routes that typically go through the Suez Canal are back through the Suez Canal, and they seem pretty confident that they're eventually going to get back to 100% over time. Obviously, if things change in the area in the Red Sea, they can divert back through Africa. And we were a little bit surprised about how confident they are about the fact that even though that ships are going to start going through the Suez Canal again, which is going to add capacity to the market because it's going to cut down the trip between Asia and Europe by 10 to 12 days. It's really not going to impact rates that much. And they cited increased congestion, not only at the ports, but also inland as well. And, as ships do return to the Suez, it could, in the short term, increase congestion as well. So keep those rates up. And the company noted that in the second quarter, their global rates were up around 22%, which was well above expectations and helped drive the beat, whether it's on the operating income or EBITDA side for its oceans business.
When you look at these companies, how much do the president's trade policies kind of contribute to what they're seeing in terms of their successful earnings here? I think of the way that in advance of tariffs, companies tried to rush goods out of China, for instance. Does all of that continue? Or are we still seeing kind of the knock-on effects or the follow-on from what the president's put in place here when it comes to trade policy?
Yeah, obviously, tariffs on, tariffs off impact supply chains, and shippers try to get in front of that. So that's definitely had something to do with it. We did see also some shippers pull forward some peak season demand a little earlier than normally would have, just to make sure that their freight's going to get where it needs to go, just because of the dislocations that are created by whether it's the Iran war or what's going on in the Red Sea. So they were just looking to kind of make sure that the products are on the shelves, and the congestion that I cited earlier is not helping things either.
Lee, Hormuz matters a lot for oil, right, and for petroleum products generally. How much does it matter for container shipping?
Well, the container shipping industry in the Middle East, it's not huge. It's low double digits in terms of the percentage of the overall market, call it 10%. So it's not a huge part of the overall market. And so, the biggest issue that we saw during, the conflict between Iran and the U.S. is a lot of ships got caught stuck in the area, and they couldn't leave because fear of getting hit by some sort of a missile or something like that. So obviously, shipping companies were really concerned about their crew and their assets and limited the movement around the Strait of Hormuz. That part of the market seems to be kind of quiet right now. You're not seeing a lot of ships going in and out of there. Maybe, if there's a lasting peace, you can see a normalization, and that will probably have a slight headwind for earnings or rates, should I say, that could impact the overall capacity of the global market, which is expected. The global liner market, in terms of volumes, is expected to increase around 4 to 5% this year.
None, as of last check. I think no ships going through that strait as of today. Lee, let me ask you just about kind of the legacy of COVID, the pandemic, the way that's kind of shaped the way these companies are acting today. How much can you attribute these good results to changes that they made in the middle of the pandemic or in light of it? How has that kind of set them up for the current conflict and situation that we're in?
I mean, the container liner industry has not been very rational when it comes to their order books in terms of buying new ships. It's actually a boom and bust market. Maersk has actually been pretty conservative with their ordering, and they're not necessarily so concerned about being the number one, number two, or number three carrier. At least that's what it appears to be. And they're really more focused on, ROI, and they're focused on really expanding their reach within the supply chain beyond their traditional liner business. So, I think Maersk is a little different than the rest of the industry when it comes to that.
We heard from Hapag-Lloyd. I guess Costco is another big one that we will hear from. Lee, the entire industry, is it all benefiting, or there's some fragilities for some of the companies?
Yeah, I mean, absolutely. I mean, higher rates, it's a fungible system that we have here. If Maersk is having higher rates, it's a good chance, or it's probably a very high probability, if not 100%, that everyone else is enjoying the same higher rates. And that really trickles down into the margins. You saw margins for their business coming in, their ocean business coming at 8.9%. That's up from 4.3% last year, and consensus was only at around 2.7%. So, the beat on the margin side really has to do predominantly with the rates, but Maersk has also been really active on improving the overall productivity. Has a marketing alliance with Hapag-Lloyd called the Gemini Alliance, and between those two, they're able to take costs out of delivering a container. And you did see their cost to serve decline slightly year over year, even when you had higher fuel prices.
With shares up 30% year to date, 10% of that today alone. Lee, thank you so much. That's Lee Casco of Bloomberg Intelligence. Still ahead, Liftoff CEO Jeremy Bondy joins the show following the company's first earnings report. This is Bloomberg Open Interest.
This is Bloomberg Open Interest. I'm David Gura. We've been playing around with modifiers for the word benign this morning. Kind of benign, sort of benign, used to describe the producer price index data that we got this morning. Wall Street graded it. We look at the major indices right now. We see the S&P 500 up 0.8%, the Nasdaq up 1.2%. We were talking with RaeAnn Mitrione just a moment ago about small caps. We see the Russell 2000 up 0.2%. I want to talk about a few companies in specific, if I could. We're getting a lot of earnings still. The AI trade very much front and center. We see Cisco down 7%. Chuck Robbins trying to turn that company into an AI player here, having some difficulty doing that. Wall Street not liking the conservative forecast that he announced yesterday on that earnings call. Cerebras Systems down 10%. StubHub disappointing earnings. Dell Technology rising this morning on the heels of some Lenovo earnings that were impressive. It up 3.5%. Want to end with a sartorial contrast, if I could here. Birkenstock up 18.8%. Tapestry, owner of Coach, Kate Spade, that down 15.75%. Coming up here, we're going to speak with the Liftoff CEO Jeremy Bondy about how AI is driving his company's next phase of growth. That's coming up on Bloomberg Open Interest.
Liftoff reported its first results since going public, with revenue up 35% from a year ago. Now the mobile ad tech company is betting on AI to compete with larger rivals like AppLovin. Joining us now is Liftoff CEO Jeremy Bondy. So Jeremy, what can you tell us that would enthuse us about the shares, given that we're seeing a sell-off even though you reported a 35% increase?
Thanks for having me back on the show, Vonnie. It was a really strong quarter for Liftoff. We grew 7% quarter over quarter, 35% year over year. We expanded EBITDA margins, and we have a head full of steam heading into Q3. Most of the growth that we saw came from existing customers. We performed better for them, and that's the engine of this whole business. We help apps acquire valuable users, and we help apps monetize their user bases through advertising. The secular tailwinds are really strong, and we're excited heading into the back half of the year.
Jeremy, very interested in those existing customers. Sort of, what are they telling you about their appetite to spend money on advertising? Or if they're not telling you that, sort of, what are you seeing in the data in terms of their capacity or appetite to do it?
Yeah, exactly, David. It's a great question. When we look at the market right now, the secular tailwinds are very strong heading into mobile app. If you look at the density of mobile app economics, mobile app is monetizing at 1/6 of the density of TV right now. So the secular appetite is huge to build an app presence as a business. And this is across categories. Liftoff works with advertisers across gaming and across all of the other major verticals that you see in your phone every day. For instance, sports books, which was thematically relevant in Q2, travel, those who are booking hotel rooms. And so if you look across the categories, the appetite is quite profound, and we're seeing that play out through our business as an index for the app economy.
So your core AI platform is Cortex, right? How do you convince the small business owner that it can really bring them that incremental advertising, revenue that will come from the incremental or marginal consumer?
The beauty of our business is that it is a perfect meritocracy, and that as an advertiser, you will only continue to spend with Liftoff if you're acquiring users that are hitting your KPI. So let me explain that. What that means is an advertiser wants to pay for a subscriber or pay for someone who will book a hotel or book a ride as a ride-hailing app or open a prediction markets account. Now, in order to continue to spend with a company like Liftoff, you need to be acquiring users that are ROI positive. So the beauty of this business is that the overwhelming majority of our customers are tracking the performance of those outcomes on a minute-by-minute basis, rather than if you look at some of the older world advertising where it may be asynchronous in terms of setting up budgets for the given year, it's always on with a business like Liftoff and Cortex, which is our answer to AI today. The implementation of Cortex is purely in our recommendation engine. So it helps recommend ads for advertisers. This is probably the most profound economic application of AI today, driving profits for businesses today.
We mentioned your rival, AppLovin, at the top, just down the road from you in Palo Alto. This is a bigger company, and I wonder sort of what your pitch is to a company about what you can do versus what they can do. It's again, a more sizable company. I imagine they have more data than you do. Differentiate yourself between them, if you would.
At Liftoff, we work with advertisers across the entire app economy. The customer breadth is a really important distinction. We work with advertisers in gaming, but also across all of these other verticals that are growing at a quite rapid rate, with our external studies showing a CAGR outside of gaming in app of 14% from 2026 to 2030. And so if you think about all of those verticals that we're familiar with watching advertisements on TV for, they're coming to app, and we have been working with all of these verticals since our inception, truly as an index. Now, what I would also say is you need at least two of us as an advertiser to grow your user base with a composite of models that are helping you find your users. So each one of our recommendation engines functions differently, from app to Liftoff to others, and a smart user acquisition manager or a smart growth marketer is using multiple partners to try and get the perfect cohort for their business.
So Blackstone is involved. It's probably too early for Blackstone to sell its stake, but do you think there's an overhang because of Blackstone's involvement?
Blackstone has been a great partner. We've worked with them very closely for 7 years. We are very, very long-term focused, and as are they. We think that having a shareholder like Blackstone has helped us in getting to the public markets and having the strength as a business to deliver a really strong value proposition. We're going to be long-term focused, and we'll continue to work with our shareholders to deliver results that deliver for all of those shareholders, inclusive of Blackstone.
I wonder if there is, maybe lastly, a pool of ad dollars you haven't been able to get access to that you're eyeing. Sort of when you think about growth of the company, sort of where you'd like to see the company move next.
The future is vast for ad tech. When you look to what can happen in the mobile app economy that hasn't yet, there are a variety of verticals that have really just started forming that will be looking to acquire users through the in-app channel. I think very well chronicled the LLM population. We talk about a lot of those businesses today. They will be focused on growth marketing as the quarters roll on. You also have a lot of different really big endemic verticals outside of what we typically see in performance that are enhancing their focus on measurement and enhancing their use of AI. And so Liftoff really benefits twice from AI in that sense, in that we talked about how we apply AI in Cortex. It helps our recommendation engine, but our customers, and I think well covered in this earnings cycle, are starting to use AI to grow their businesses and enhance their user funnel, which will then make performance marketing a lot more effective for them through app. And so we benefit twice from that secular shift. I think that the categories that can come are really a function of the tastes of the three of us and other consumers out there. What types of apps do we engage with? Well, we know that those businesses will be working with Liftoff to help grow their user base.
All right, Jeremy, the very best of luck to you, and thank you for your contribution today. That is Liftoff CEO Jeremy Bondy.
Thank you so much for having me.
Let's get a check on markets now. We are seeing a very risk-on day when it comes to equities, with the Nasdaq at session highs now of 1.4%. Practically across the board, we're seeing gains, except for a few of the obvious standouts in terms of earnings, like Cerebras and Cisco. The S&P 500 up 0.9%, and then the yield curve is the story of the day. Markets frantically pricing out rate hikes, at least till December, if not this year at all, with the 10-year yield right back down to 461.71. That's a 7.5 basis point move, and it's mirrored across the curve. And you wonder what it's going to mean for that 30-year auction in just 2 hours, 20 minutes time. We'll see. This all coming as well as oil backs off. So we're at 86.69 now for Brent crude. Let's get a look at some other movers on our radar now with Bloomberg's Emma Palmer.
Thanks, Vonnie. First up, we're going to dig into luxury. Some pain over at the parent company of Coach and Kate Spade. Shares of Tapestry are sliding down nearly 16% after posting disappointing forecasting for 2027. Still, Coach may be its crown jewel. Sales of Coach items jumped 15% last quarter. And we're going to pivot to the ticket game. StubHub also struggling this morning after reporting missing earnings. Down about 13% so far this morning. Even the mad rush for World Cup tickets wasn't enough to offset StubHub's surging costs. And finally, we're always keeping an eye on SpaceX after it released a new AI model yesterday. Shares have been on a tear since the first lockup ended last week, adding roughly $500 billion in market cap. They're down a bit this morning. We can't get enough of SpaceX news, right,
That's
David?
Absolutely right. Emma, thank you very much. Appreciate that. Want to get more on SpaceX with Bloomberg Tech host Ed Ludlow. Look, Ed, my understanding is the Starship is a 2-stage rocket. Let's look at this lockup period as a 9-stage production here that SpaceX has engineered. So much hand-wringing, so much worry about what that first lockup period's end was going to mean for this stock. Low, it seems like it wasn't that big deal at all. Talk about the uniqueness of the way that SpaceX has approached this and sort of what we should be thinking as we get to August 20th in these later stages of these lockups.
Yeah, I mean, SpaceX has passed the test of that initial lockup expiry, right? It is unique, or complicated is probably a better word, where between now and the end of next summer, there are different flash points where different volumes of restricted stock become available to the market. So last week it was 911 million shares, and from the close of August 5th to last night, the stock's gained 35% in those 5 sessions. I get it's down today, taking it back over its IPO price. So that's kind of like psychological, right? And what I found very interesting is within the data points is, okay, you get 911 million shares hit the market, be free from lockup. But actually only 255 million shares changed hands. And I think that the overriding sense I get from speaking to many shareholders is that just because you get a lockup expiry, it doesn't mean people sell. You know, that there is evidence that people held on to it at the largest scale.
Well, now that the valuation is back up 35%, does it make the Tesla question relevant again? Because when the valuation had been dropping, there was a question mark over whether SpaceX would even be able to consider bringing Tesla into its conglomerate.
Well, at this stage, we just simply don't know what the state of play is. You know, the idea that Tesla merges with SpaceX is there. The market considers it and discusses it often. It did not come up on SpaceX's earnings call. It had come up on Tesla's earnings call because a sell-side analyst posed the question to Musk during Tesla's call. SpaceX offers a mechanism where retail investors can pose questions to SpaceX management in advance of the call. It's their own tool they use by building on top of Grok, their XAI chatbot, like Tesla uses Say.com. And if you looked at it in the days ahead of the SpaceX call, there were loads of questions about SpaceX and Tesla merging. But what happens is the IR team filters through them, and as was outlined by General Counsel on the Tesla call, basically the management teams will say it's not an appropriate forum to discuss it. The price and the valuation, the mechanics of a deal, I think we're so far from that, Vonnie. It's hard to gauge just because the stock is lowest relative to where it was.
Very quickly here, just about the company, and we've been through its first quarterly earnings now, and you and I have talked so much, Ed, just about the grand ambitions of this company. Moving away from just the stock price here for a moment. Any clarity sort of on the trajectory in terms of them executing some of the wilder dreams that they've proposed?
Yeah, I mean, the two big numbers were $100 billion annual revenue run rate by the end of this year, and that they will hit $1 trillion of real revenue in 2030, maybe 2029. But the things that's driving that in the near term is their business of renting out cloud capacity to third parties, not necessarily selling AI software. And the surprise was that they are aggressively pushing into the space of the US carriers, taking on T-Mobile, AT&T, and Verizon, and basically explaining their plan is not just to have a satellite-based constellation of direct-to-sell, but work on their terrestrial assets as well, and that's what moved the needle in the moment. So it's all happening in real time. All eyes on Starship, the two-part launch system, because all of its future business lines are still predicated on that being it working, but also being rapidly reusable.
With fewer than 20 minutes till the start of his show, Ed Ludlow joining us here on Open Interest. Ed, thank you very much. Appreciate it. And coming up here, Nelson Peltz looking to change the recipe at Wendy's in a bid to revive the struggling fast food chain. We're going to get into that next here on Open Interest.
We are watching shares of Wendy's down almost 2% now after the Financial Times reported Nelson Peltz is preparing a bid to take the struggling fast food chain private. Joining us now is Bloomberg investing reporter Hema Palmer. I don't want to call it an obsession, but he's certainly been involved and very involved with Wendy's for decades now. Why is it not successful?
You know, it's been a company he's been investing in since the early 2000s, really. Taking a sizable stake in the company. They currently have more than 17% equity stake in this company that, yes, has been struggling for some time. And right now, the things it's struggling with is inflation, consumer spending costs coming down. It had to revise its outlook for the year. They have a new CEO that's trying to make all these changes and really lift it up. Clearly, Peltz thinks that him and his consortium, if he gets it together for this bid, will have a proposal to really fix this firm that's really been struggling for some time, and against the competition too with McDonald's and Burger King.
Maybe he's just a fan of Frosties. I don't know. I don't know what's driving Nelson Peltz, but let me just ask you about the state of this restaurant chain.
Yeah.
Has a new CEO. He came out last week, said that he was going to withdraw the outlook, cut its dividend. Yep. Things aren't going the way that he wants them to be going. Talk just a bit about the state of Wendy's today.
Yes, yeah, it's been struggling for a number of years, and I think the firm realizes that the CEO has come out and said, look, this is, we're struggling here, this is a problem, we need to get things going. So the firm seems to realize that it has a long way to go, and it seems to be making some efforts towards that. But yes, all of those things you laid out really at the core of the problem here, underperforming the competition, struggling for some time. The stock down 50% from 2 years ago. And this is the second time that Nelson Peltz has explored something like this in 2022. Yeah. He thought about taking a controlling position.
Is it that nobody wanted to join him then? And then who will he look to make up this consortium now? Will it be successful?
Well, the first one fell apart, but this one, as he's trying to get together the other shareholders to gather a consortium here, he already is a pretty sizable equity stakeholder. Maybe it's a buying the dip sort of a proposal here to see what you can do to fix it. But yes, he had joined the board in 2006. Peltz is on the board of other food companies like Heinz and Kraft. And he's an activist investor. What he does is coming into companies and trying to fix them and exploring changes. And maybe until he does this kind of a move, he feels like he might not be able to see the kind of changes he would like to.
His son Bradley on the board as well, Bradley Peltz on the board. Just want to ask you last about this trend that we've seen here. So we have Subway that was kind of taken private. Of course, Jersey Mike's. We had Danny Berger speaking to the CEO of that company as it went public after Blackstone had its role in it. There is a trend emerging here of companies taking an interest, private equity companies taking an interest in consumer goods and food companies.
Yes, yeah, it does seem to be a way in. And maybe that echoes this move, the shift towards privates that we're seeing, right? Taking an equity stake, in this case, potentially taking it private. Some of these things are highly illiquid if you do go the private's way. Bill Ackman today is launching a new venture fund for his investors. So we are seeing some of these big entities, whether that's equity funds, hedge funds, private equity, really making these shifts and speaking with their voice and their dollars.
A huge amount of capital markets activity, and probably no small part because we've seen high after high after high, and there are profits being made. Wendy's, though, is fascinating. Robert Wright had been at Potbelly and also was a board member at El Pollo Loco, and he is the new CEO, so we'll see.
Yes, see how they do. We'll watch it closely.
Thank you. Looking forward to reading more reporting on Wendy's. That is Bloomberg's Hema Palmer. Coming up, Iran issuing a fresh warning on Hormuz as defense stocks hit a record 10-day winning streak. This is Bloomberg Open Interest.
Iran saying no ship can safely pass through the Strait of Hormuz without its authorization. Meanwhile, the Bloomberg Defense Primes Index is higher for a record 10th straight day as the war with Iran passes the 5-month mark. Joining us now is Becca Wasser. She's the defense lead for Bloomberg Economics and has led studies and war games for the U.S. Department of Defense before she started here with us at Bloomberg. Becca, great to see you once again. And you have done this in-depth analysis of the weapon stockpiles the U.S. has and how they've been reduced by this ongoing conflict in the Middle East. Give us the top line, if you would, here. I know a lot of this material is classified. We don't have kind of full transparency into sort of the size of these munitions stockpiles. But what have we learned? What has your analysis led us to learn about the state of those stockpiles?
Yeah, we estimated some of those stockpiles, and we found that some of the critical air defense interceptors, Patriot missiles, THAAD interceptors, those are dangerously low right now, and that poses a lot of problems for the United States. We also found that the U.S. is likely running a bit low of its preferred munitions, some of those high-end, exquisite, long-range missiles. And that's going to force some hard trade-offs for the United States. But that doesn't mean that the U.S. is all out of missiles. It still has some of the gravity bombs that are quite plentiful in its arsenal that it could use. But all of this takes place against the backdrop of the Pentagon trying to ramp up efforts to build munitions. And we're seeing that reflected a little bit in some of these defense stocks as we see that steady demand signal coming from government to industry.
So, Becca, when the president says he's holding off on decapitating Iran, is it an empty threat, or would the military be using some of those gravity bombs? What would they be using in that scenario?
I think right now he's holding off on Iran because he wants to choke them off economically. And that's essentially providing the U.S. with an opportunity to kind of sit back and regroup. Obviously, these missiles can't be produced overnight. That's not how it happens. These have really long lead times. We are looking at years to actually build some of the air defense interceptors. But it does mean that, you know, frankly, the president could still decide to strike Iran. It just means that he could do so at higher levels of risk to U.S. forces, to U.S. allies, and that is constraining some of his operational options, which may be why he's gone with this economic path right now.
We're getting to something that you note in the report, and that is that the choices the U.S. faces now come at a high cost. And I think there's a lot of concern about what the depletion of these reserves means for, you know, if there were to be another conflict somewhere else in the world. How real is that level of concern? We've seen the degree to which the White House has pushed back quite vociferously on reporting that you know, the U.S.'s position here is jeopardized as a result of having spent a lot of those munitions in the Middle East.
It's a real cause for concern. It is a true, genuine thing. If you look at some of the potential missiles and munitions that would be needed in a future conflict, say in the Indo-Pacific, potentially with China, the ones that have been depleted in the Iran war are the exact same ones. As you said, I ran war games for the U.S. Department of Defense and for other allied entities. And in those war games, when we were trying to simulate what could happen, the U.S. would often run low of the most critical munitions in just the first few weeks of a potential fight. And that was already saying that the U.S. didn't have enough in its arsenal. And now, with its stockpiles even more depleted, that becomes a really critical problem, which means deterrence might also be weakened.
Becca, we know the public has no appetite for foreign wars. With the midterms coming, if the Republicans lose the House in particular, what is the outlook for defense spending?
Well, I think we see that there's a little bit of ebb and flow in defense spending. The market sometimes gets it wrong when they see that there's going to be potentially what they view as an end to a conflict, even if it is one of these longer forever wars that drag on and on. But I think here, you know, the market wants to be optimistic. It wants to believe that the war is going to end, and you might see that reflected in defense stocks. But at the end of the day, the replenishment is going to be massive, and that means that defense is going to be a hot button item for time to come.
It is a must-read report by Becca Wasser and Courtney McBride, both at Bloomberg Economics. Becca, thank you very much. Appreciate it. And coming up tomorrow, strategist Sarah Hunt of Alpine Sachs and Woods is going to join us, along with commodity investor Doug Daly, as we look ahead to consumer sentiment numbers. We'll dig into those on Bloomberg Open Interest tomorrow. Stay with us. This is Bloomberg.